But we're also being joined by Ankur Rudra, investment analyst at CLSA India, for a live conversation. Ankur, appreciate you joining us this morning. You know, you look very closely at the entire IT and internet space, and I want to start there. We've seen valuations for internet companies, you know, whether it's e-commerce, whether it is other niche segments, picking up. What are your comments on those huge skyrocketing valuations we're seeing?
Hey, thanks for having me over. Now, clearly, the internet and the e-commerce space for India is just about scratching the surface right now. So it's not a wonder that valuations may not make sense at the moment. But I think it's a combination of how successful people have seen the Chinese internet names, including Alibaba's recent IPO and performance since then. And they want to bet for the next big driver and a next big performer from here. So I'm not surprised to see the valuation. This is typically what you'll see in the first early nascent phases of the industry. But I think we've got a long time to go there as well.
Ankur, congrats for your new role at CLSA as well. And let me start off by getting a sense of the way the earnings season's really played out, because that's really been something which has been fresh in investors' mind right now. We just got the earnings season concluded just a few days back. Any key takeaway for the IT space here?
Hey, thanks. So yes, I think the second quarter earnings season was quite interesting. We saw a few trends. We've seen, I think, primarily growth rates converge between the leaders of the sector. So in the last 2 or 3 years, we've seen Cognizant, TCS and HCL Tech leading the pack, and Wipro and Infosys somewhat being a laggard. But this time we saw somewhat of an opposite trend, where Infosys did well. Wipro's IT services growth has inched up towards 10%, and whereas we've seen a somewhat softer performance by TCS, HCL Tech and Cognizant. So maybe that phase of extreme high polarization is beginning to go behind us somewhat. Having said that, we did see some checks on the expectations of very strong growth by the faster performing companies. We saw some greater than expected cross-currency movements from Europe, and it sort of indicates how important Europe is becoming for everybody's growth rates. And lastly, I think the biggest positive indicator for me was net hiring picked up across the sector. If you look at Infosys, Wipro and HCL Technologies, each of these 3 companies were not hiring significantly, depending primarily on just-in-time hiring. Them hiring at about 5% of their overall employee count this time indicates a bit more visibility into the next 1 year, because a lot of their hiring is actually graduates, and they haven't been hiring graduates for a long time. Graduate hiring typically indicates improving visibility. So that's a big positive for me.
I want to continue focusing on the earnings season. I will come to Europe in a bit, but you were talking about hiring, and it's interesting what you're pointing out. But you also, on one hand, you're seeing hiring going up. On the other, attrition for the second quarter in a row for all your IT giants has continued high, coming in over 19–20%. What's your view there? Do you expect that will soften going forward?
So typically, attrition building up is a sign of improving demand, because people have not moved much in the last 3 or 4 years. So some of it is clearly positive. It does indicate that the industry is seeing better growth rates. It also indicates that the skill sets required for growth these days are somewhat changing. So we are seeing this new trend towards new digital or social mobility, analytics and cloud kind of technologies, which is leading many people to look for alternate jobs, and also people getting poached where the skill sets do lie. So it's a combination of service line mix change from a growth perspective, and growth coming back is really reflecting this. I think it's the phase of the industry we are going through. And I think it will remain somewhat elevated for at least the next 1–1.5 years. I don't see that changing. Now, along with that, you've also seen utilization numbers. I think you referred to that has been up for many of these companies for a bit. And I think going forward, we see companies working at similar sort of utilization levels while backfilling and also hiring for growth.
Since we're talking about just the macro trends out here, Ankur, you want to touch upon pricing and demand as well, as to how that's shaping up? I mean, looking at the way the quarterly numbers have played out, any key takeaways in terms of the interaction that took place post the numbers as well with management? What kind of sense are you picking up in regard to demand and pricing?
So I think, to be very honest, for this sector, the traditional way we've been looking at it from a pricing and volume perspective has become increasingly less relevant, because many contracts are being sold on a fixed price basis. So what we focus on is a bit more on the realization side. And on the realization side, we have seen continued somewhat of a softening. But I think it's more of a function of the service line mix. For the last 3 or let's say 5 years, we've seen some of the more commoditized scale services like infrastructure management, BPO, testing, application maintenance, growing faster than the rest of these service lines, and these typically come at low realization. So I think it's a continuation of that trend. Having said that, we do see the beginnings of discretionary spending, and this I think will build out over the next 2 to 3 years. So as that builds out, we'll probably go through a phase where realization continue to soften, at least for, let's say, 12 to 18 months, after which we see them picking up as the service line mix goes back towards discretionary spending areas like ERP platforms or digital areas, which will drive up realization. So for the next 4 years, I think 4 quarters, sorry, it will keep softening and then it'll strengthen up after that.
Ankur, I want to go back to that point you were making about attrition. You're saying that it's really an indication that demand is picking up. But in terms of salaries, while most IT companies speaking to us have not given us a specific figure, they're saying that year on year, that really hasn't increased. But on the other hand, you've seen, say, a company like Infosys give out that massive bonus. Do you expect there will be some correction going forward?
So I think, from a salary perspective, Infosys is probably a bit of a special case because it's been a bit of a laggard for several years. Many promotions, salary hikes, etc. were pending. It was also going through a period where the employee morale was somewhat subdued. So I think that's a bit of a company-specific thing. Well, having said that, yes, you're right. For the sector, as attrition goes up, we do see salary hikes inching up somewhat. We don't see corrections coming through because, we are entering a period of more visible, sustained demand. And we'll probably see higher single digits, very low double digits kind of salary hikes. We don't see a substantial increase. I don't see a hark back to the times of 2006, 7, 8, where salary hikes were in the region of 10 to 15%. But surely 8 to 11% is possible.
Talking about the entire IT pack, from amongst the pack, coming off earnings season, seeing the way that has panned out, what are your top picks in this space?
Our top picks are Infosys, TCS, and HCL Technologies. I think Infosys is very interesting because I think from being a growth laggard for the last 3 or 4 years, we're seeing very strong signs of a recovery under the new management team, and also how strongly they're positioned for the new growth area around digital or SMAC. I think TCS and HCL Tech remain strong performers. They've been doing well across the last 3 or 4 years. I think that should continue going forward as well. We've had misses from both these names so far, but I think they were one-offs, and you should see them recovering going forward.
What about the broader market space as well? Because yes, some of the index names that we've been tracking, but the mid-cap space has been pretty interesting as well. And the way numbers played out, and anything from that segment on the non-index companies that you're tracking from the IT sector?
Yeah, sure. I think especially if you look at the last 1.5 years, the mid-caps have done fairly well. Yeah. I think most stocks are up more than 100%. Some of it is helped by the fact that they tend to have more offshore leverage, and hence they benefited from the rupee depreciation quite a bit. But even if I leave that aside, from the next 2 to 3 year perspective, I see social mobility, analytics and cloud, or digital, as many companies like to call it, is becoming a very big theme. The 2 stocks which I think will benefit from this a lot are Persistent and Mindtree. Both these companies have a significant proportion of business coming from here. Both the stocks have also done well. They are both trading in the low to mid-teens area, so not as expensive as one would fear. So I think those are the 2 very interesting names to watch out for.
Ankur, IT of course is topical, it's always hot, but I want to focus and talk about the internet space as well. Now we've seen e-commerce companies, you were just talking about valuations. Which of these companies or the business models do you think are really exciting sitting where you are? And also, we, for example, have spoken with Uber, and the taxi space is also so hot right now. So I wanted to comment on both spaces, both e-commerce as well as, what's happening as far as taxis go.
Yeah, sure. So I think, clearly e-commerce is a great long-term story in India. We see, the penetration of e-commerce into modern retail increasing at a very rapid rate. It's helped by several factors: a huge young population using smartphones and 3G connectivity, internet connectivity for the first time. Great applications which help you shop better. So I think the 3 big companies in India which will benefit from this clearly are Flipkart, Snapdeal, and Amazon's presence in India. I don't think it's that competitive yet because it's a very big space. I see that they all growing the market on an overall basis. There also will be niche companies which do well in specific segments, either in terms of apparel or furniture, etc., and what have you. So I think e-commerce remains a very interesting space in India. It still is in its nascent build-out phase, where you'll see many companies increasing the addressable market. Taxis is very interesting. I think the apps we've had so far, Uber, Ola, etc., have done a very interesting job. We've heard several stories of people, especially in big cities where Uber and the likes of them operate, people stopping travel in their own personal cars and using Uber, given how convenient it is. And this is just an example of how technology is becoming a lot more pervasive in our lives. And from a very personal experience, I've stopped driving. I've begun to use Uber all the time. It's very, very effective.
I'm sure Uber's listening to this very closely, but I want to go back to the e-commerce bit that you were talking about. Now, while most brick and mortar companies are looking at the space closely and they're saying they're interested in e-commerce, they're also saying that there should be a level taxation, playing field, so to speak, for both a brick and mortar as well as online companies. If that does come into play, how do you think is really going to change the dynamics of the e-commerce space?
So I think historically, nascent industries have benefited from a more, comfortable taxation regime. We've seen during the formative years of Indian IT, they benefited significantly from the Software Technology Parks of India initiative. So it does make sense to help new industry like e-commerce to do this. And from an employment perspective, this will probably create a lot of employment as well, because there are several avenues for them to grow. It's not just the competition with the existing retail space, they also expand the market quite a bit. So I wouldn't be surprised to see that. I don't think we should focus so much on the competition between these two. I think there will probably be an impact eventually, but I think it's still too early for that. It's difficult to exactly compare taxation for e-commerce companies with exact retail, because retail has different drivers and different cost centers, and I don't think taxation makes as much of a difference yet. But I think a uniform taxation will probably bring, in the very long term, a more level playing field. Today, it's much more about making consumers aware and making them address both these target markets better.
All right, we've been discussing the sector from a full perspective there. I got one more question, Ankur, to ask you. What are we watching out for now for the next couple of quarters? What are you telling investors to closely monitor when we talk about the IT sector?
I think we're entering clearly a period where typically sequential growth tends to be softer because of the seasonality in the sector. Okay. So the couple of main things that people will want to watch out for is, given we've had a spate of a few soft misses. So for example, Cognizant, TCS, HCL Tech all had soft quarters in the last few quarters. So we think any reiteration of the overall growth story by the end of this year. So between the January result season and February, when you will hear full year growth expectations from the likes of Cognizant and from NASSCOM, is something people will watch out for very strongly. We'll also want to watch out for, is discretionary spending uptick that we saw in the last few quarters, does it continue into next year or not? I think those are the two big drivers people will want to focus on to see where the sector goes next year.